Hey everyone, welcome to today's Study Trader video. Well, earnings season is about to kick off and I'd like to make this sort of video reminder at the beginning of every earnings season to kind of explain what I have found to be the best and most profitable and less stressful way to make money during earnings season around earnings moves. What a lot of people do is they will make a bet on a specific earnings outcome or a specific reaction to a stock after any given earnings report on a single name stock, let's say Netflix, for example. And they're hoping that the stock will then react in a certain way. I can tell you empirically, and we've proven this through statistical analysis and everything, that there's about a 40% chance of making money over time if you make that kind of bet. A much higher probability way of making money, closer to 80–85%, is by making a bet after a stock has already reported its earnings. So let me show you guys quickly what this looks like. So for example here, this is shares of Micron Technology. And I just like to use this stock as an example because a lot of people know it. And what happened is the company reported earnings. You can see there's a bit an E down here. I'm going to make this a little bit further up in the chart. So you can see this is when the company reported earnings. So instead of making a bet that the stock might, let's say, go higher before the earnings report even hits, which I would have been proven totally wrong on, what we did is we like to wait for the earnings report to come out. And then based on that reaction, and you can see the stock then drop very quickly, we then would make a bet that the stock isn't going to rise much after it's already dropped. Now, there's various ways in which you can express these views. You can make directional trades. You can either in that type of situation, then when the stock, let's say, breaks down after earnings, you can buy puts or buy put spreads or short the stock, or even do credit spreads, which is a lot of what I like to do, where you are selling option premium, which is a very conservative way of also then taking advantage of the implied volatility collapse. But that's another topic for another time. The point is here, again, just kind of going back to this example, if you make a bet on a stock into earnings that it ultimately is going to have a certain outcome. So let's say in this example, a lot of people probably made bullish bets and because the stock was consolidating, and so a lot of people had bets that the stock would go higher, but it didn't go higher, it went down. And by the way, a stock we've seen it all happen. We've seen companies report good earnings and good outlooks and the company drops after earnings, or the stock drops. We've seen companies report lousy outlooks and lousy earnings and the stock rallies. We've seen companies report amazing earnings, amazing outlooks, the stock rallies 10%, 20% in the opening hours of the next trading day, but then closes down like 5 or 10% on the day. All the scenarios are possible, and that's because a lot of fund managers like to make decisions based on some of these earnings reports. And so you really have no edge going into an earnings report trying to gamble on that specific outcome. Again, you might be able to make money on a trade or two here, but over time, and I mean over time, if that is like a thing you do all the time, over time you will most likely lose money, again, statistically speaking. So anyway, so that's what we do, and we're going to be sharing some of these ideas here as earnings come out this earnings season as well here in the YouTube videos. Anyway, just wanted to give you a little bit of knowledge on that. I hope that makes sense, and wish you guys a great weekend. I'll see you guys on Monday.